Well, as we've been talking about, the markets have been trying to price in a lot of data lately. Central bank policies as well, earnings, the latest CPI and PPI reports, the jobs report. To some investors, the data seems to be pointing to a soft landing as the Federal Reserve continues to fight high inflation. To others, like our next guest, we may see a longer path down to that coveted 2% target. Let's bring in Mizuho Securities USA U.S. Chief Economist Steven Ricchiuto. Steven, good to see you. Thanks for being here.
Pleasure.
It is hard to synthesize all of this data and come up with a clear picture. And I did see some commentary recently from Alan Blinder, formerly of the Fed, who said the stuff that's happening now in the economy is not really even because of the Federal Reserve, right? Because there is this long and variable lag, we still have quite a while to wait before the bulk of their increases actually hit the economy even.
Well, the reality of the situation is we're in the window where it should be happening. You can't say there's that much longer to go. If you're in the window and it's not having the effect, and if you look at the things like the Atlanta Fed nowcaster suggesting the economy's actually accelerated into the third quarter of the year, that really goes to suggest, well, Alan, maybe you're missing the calendar here. There's something fundamentally going on in this economy. What's going on in this economy basically is the forward structure of rates is anticipating that the Federal Reserve is going to cut rates. And typically in a tightening policy, the markets are not this forward thinking. So the yield curve, the spread between, let's say, the 2s and 10s, most of the inversion happens from 5s to 10s. This time it's from 2 to 10s. Almost all of the inversion is between 2 and 5s. What this essentially means is where consumers fund, basically in the securitization market, is not having the effect that it normally would have, because the markets are looking through and saying, this isn't going to last long. So it's not having the effect. And that's really the problem. It's kind of like I'm giving you a drug, but then I'm giving you half of the counteracting drug and expecting that to cure you. It's not. And that's the Fed's problem.
Is the current structure of the economy screaming soft landing right now?
I think the current structure of the economy is suggesting that inflation's bottoming out. And it's bottoming out at a target, at a level well above the Fed's target. You look at the CPI number yesterday. To me, the most glaring aspect of the CPI was the goods prices are declining, service prices are rising. Goods prices are declining because the global economic backdrop is not good, which then goes directly to the point of, well, if I look at the equity market, okay, there's no pricing power that's going to be left in a lot of these companies. So if there's no pricing power and I had 2% growth in the economy and I had some pricing power in the first part of the year and I still had a decline in earnings, how am I going to get 11 to 12% rise in earnings next year with less pricing power and supposedly less growth? So there's a lot of contradiction that's built into these things that are keeping things that need to happen from happening. The forward structure of rates is keeping consumer spending from slowing. The equity market is actually keeping CEOs in a position where they're capable of hoarding workers. That's the next conclusion.
Steven, Rachelle here. A couple of meetings ago, we heard from Fed Chair Powell that the risk of doing too much was still better than the risk of doing too little and having, persistent inflation continue to permeate here. Is that still the case, though, given some of the recent data?
No, I think that's definitely the case. I mean, the Federal Reserve has a 2% target. The PPI numbers accelerated quicker than the CPI numbers. They turned quicker than the CPI numbers, and now they appear to be bottoming, which suggests the CPI numbers are going to be bottoming. And if you bottom out the CPI numbers in that 4% area on core, you're double what the Fed's target should be. You've got a lot of work left ahead of you, and the answer is this economy is not feeling the impact because the nature of the economy has changed. Nobody funds at the front end of the curve anymore. Everybody funds in the belly of the curve and at the longer end of the curve, and those markets haven't moved anywhere near as much as the Fed funds rate has, so the amount we have to get out of the Fed is greater because of the different structure of the markets and the reaction function in the markets to what the Fed is telling them.
So does that mean, something's got to give here. Does that mean that the Fed is going to raise more than one more time, A? Or B, does it mean they're going to change their inflation target?
Well, they can't change their inflation target because credibility goes out the door. Right. You want to change your inflation target at this point, you just sit back and say, okay, where's the 10-year going to go?
But also raising more than one more time is not a great scenario for their credibility either, is it?
Well, it is because they say they're data dependent. And if the data isn't there, and I don't think it will be there, they will raise more than one more time. This concept of betting on where the terminal rate has been wrong all the way through. We started at 100 basis points. We went to 2. We then threw in the towel and said 350. We're now at 550. And we're still not there. So this guess of what the terminal rate is against the backdrop of this is a very different market environment that then influences the economy. Part of the problem is the Federal Reserve's dots in their SEP. They're telling the market you're going to get a soft landing, so the equity market priced in a soft landing. They tell the market, oh, we're going to be cutting rates next year, so the market prices in that they're going to be cutting rates next year. But then in their rhetoric, they have this conversation of higher for longer. So which is it? They're conflicted.
Well, but if I may, it's not just the market, and it's not just the Fed that is sending the message of the soft landing. It's the actual data is sending the message of consumers are sending the message of soft landing too, aren't they?
The data is telling you the economy is doing well.
Right.
If the economy is doing well and you have a 3.5% unemployment rate and you've got wage demands like the ones we're hearing about over and over again on channels like yours, you're beginning to ask the question, how are they going to get to 2% at this level?
Sure.
Right, that's their problem.
Yeah.
And the reality is that implies higher for longer with the reality of emphasis on both higher and longer. And the market's not appreciating that. Neither are bonds nor are equities, which opens up the possibility of a hard landing rather than a soft landing.
Is there a risk next year, considering the amount of policy that's still going to overflow into next year, an election year, where, of course, there's been the kind of separation of powers that we do know that President Biden and the administration have been trying to set forth and kind of make that clear to the consumer environment right now. But does that still run a risk of kind of bleeding over or permeating over or muddling of where there could be influence?
Unfortunately, the fiscal policy path that we have gone down is basically out of control. Okay, we have a budget deficit which has, substantially higher than $1 trillion structural deficit. That is huge. We're struggling with the amount of borrowing that we need to accomplish to fund that deficit. We're spending money at an accelerated pace relative to what we're taking in, and that creates imbalances of its own that, to be honest with you, has made monetary policy that much more difficult. And the net result is, this is a two-policy program. And one side is clearly not doing its job on controlling inflation. So the other side needs to and should.
And Stephen, when you look at some of the factors that are outside of the Fed's control, when you look at a still very tight labor market as well and see some of this wage growth here, what are some of the key things that you should be watching for that are outside of the Fed's control that are also contributing to this?
Well, I think the answer is very, very simple. The fiscal policy adjustments that are taking place, the administration's backing of very, very large union-related contract settlements, and the pro-labor component of this administration is, again, also making the job harder for the Federal Reserve to do what it needs to do. So the reality is, you've got this conflict that's going on between policy approaches, and the net result of that is basically a higher for longer interest rate environment.